Discounting cash flows. The core of corporate finance is calculating the present value of future cash flows. This concept is based on the time value of money. A company is essentially an entity that generates cash flows each year into the future. The trick is estimating those future cash flows and how much they might grow or shrink and what the risks are to realizing, i.e. receiving them. It's difficult to peer into the fog of the future. This is where you have to polish your crystal ball and do some deep analysis of the business, its markets, and competitors. All this information is compiled into a spreadsheet of financial projections, and the bottom line represents the future cash flows in each year. These are discounted back to present value at a discount rate that takes into account what similar investments, which are just streams of expected cash flows, are priced at in the market, and any and all risks specific to the particular enterprise or asset we are contemplating buying or selling. This is the basic concept of valuation. Valuation is an estimate of something's worth. Something's worth can be set at auction where people bid and the highest bidder wins. But how do bidders know how much to bid and how much is too much? For income-producing assets like stocks, it's the present value of the future cash flows, the expected future cash flows. The stock market is essentially an auction where investors place bids, basically how much they are willing to pay for a stock, and asks how much an investor is willing to sell it for. When a bid and an ask match, a transaction happens and a new price is set for that stock. Companies and assets, and even startups that don't have any revenues yet, are valued using this principle. This technique of calculating the present value of a stream of cash flows becomes essential when trying to value startups that have no revenue history or assets, or companies that are predicted to grow rapidly. In these cases, you can't rely on past performance and history in order to come up with a value based on a price-earnings ratio or the value of the existing assets. DCF, discounted cash flows, is the technique favored by investment bankers, venture capitalists, private equity, hedge funds, and savvy investors, banks and credit analysts, and CFOs. It's not difficult to understand, and you will be amazed how useful and powerful it can be. Discounting cash flows, present value and future value. $100 invested for 1 year, earning 5% interest, will be worth $1.05 after 1 year. Therefore, $100 paid now and $105 paid exactly 1 year later both have the same value to a recipient who expects a 5% return. That is, $100 invested for 1 year at 5% has a future value of $105. This assumes that inflation is 0% and doesn't contribute to eroding the value. The equation in this case looks like this. 105 equals 100 times, in parentheses, 1 plus 0.05. The general formula for solving the future value is the future value equals the present value times 1 plus the interest rate, in parentheses, where FV is the future value, PV is the present value. The reciprocal formula to solve for present value juggles the terms using basic algebra and restates the relationship as the present value equals the future value divided by 1 plus the interest rate in parentheses. It simply puts the 1 plus the interest rate term on the other side of the equation to solve for present value by dividing both sides by the 1 plus the interest rate. Now, if this is confusing to you, just replace the 1 plus r for a second by the term x. So that would be future value equals present value times x. Now, if you divide both sides by x, you get future value divided by x equals present value divided by x over x, which equals 1. So that term goes away on that side. Now, if you just then again replace the x with the 1 plus r, you see how we derived the equation. So take a moment and make sure you really understand this because it's the basis of project finance and asset valuation. This is the formula we use to calculate future cash flows as a present value. And if this is confusing, get a copy of the book and look at it in print. You'll understand it right away. So this concept is used to calculate the present value today of a projected stream of income in the future. Sit with that concept for a while until these concepts really are clear to you, because this is the core concept of finance. Basically, present value equals future value divided by 1 plus the interest rate. Now, the general formula puts that 1 plus the interest rate to the exponent of the year in which it is going to be received. So all the terms are familiar to us so far, except for the exponent n, which represents the particular year in which it's due. So for example, if the future value was due in year 2, then n would be 2. If the future value was due in year 5, then n would be 5. So basically we have the present value is the future value divided by, in parentheses, 1 plus the interest rate, and that taken to the exponent n, the year. The further out in time, the bigger n is, and the more discounting is applied to the future value. It's as simple as that. So when there are a stream of future values, these cash flows are all discounted back to the present value based on the year they're coming in, and then all those are added together. And this sum of all those added together is the present value of that entire income stream. That's the present value of future cash flows.